Welcome back, everybody. This is episode 2 of Foundation to Equity. I'm excited to get going here. Again, my name is Dave Zuller. I'm a real estate broker with Westcott Properties in Providence, Rhode Island, and I am a owner and general contractor of Carvia Construction based out of Lincoln, Rhode Island. Episode 2 today, it's going to be all about buying your first property, the things that I see people do wrong, sort of a step-by-step intro to how you start changing your mindset, thinking like an owner, get yourself in the game, and how we get an offer accepted. So if you're thinking about buying your first home, but you're worried about making a costly mistake, this episode is going to be for you. We're going to start out with what I see people get wrong a lot of times about buying their first property, and it all starts with waiting too long. Now, waiting too long could mean a few different things, and really all of them apply when it comes to buying your first home. It could be waiting too long to make the decision to buy, could be waiting too long to speak to an agent, could be waiting too long to speak to a lender. First off, you have to change your mindset. The mindset is that I'm no longer going to be a renter, right? That's a decision, a conscious decision that you have to make, that I am no longer willing to pay someone else's mortgage. I want to pay my own mortgage. By doing that, it's going to build that equity, build that wealth for the future. But you got to get your foot in the door to make it happen. So it all starts there. Let's make the decision that I am going to be a property owner, right? And that starts with putting a plan in place. Now, not everybody is going to say, I'm going to be a property owner, and tomorrow they're calling an agent, calling a lender, and getting out there looking. There's some times where it's going to take some time to put yourself in the best position, but it starts with the mindset. Make that decision, a conscious decision. I am going to be a homeowner in 2026, or by the end of 2027 even. It's an acceptable time frame because you may have to work on things like credit, or you may not have a full 2 years on your job yet. And there's a lot of little hiccups that can get in the way. So it's okay to plan ahead, but you've got to make that decision. Don't keep waiting. Decide today, this year, I'm going to be a homeowner. And that's where we begin. Another mistake I see people make is that they feel like they have to have perfect timing. There is no perfect market. The market fluctuates, right? It goes up and down in the mortgage market every day. In the real estate market, as far as values, it's not necessarily daily, but we see trends, right? And the reason why real estate works on the long run, why you stick with it, why you build that equity, and how that translates into wealth is because you're not only paying down your mortgage, but you're realizing the capital gain in the value of the property, right? Those things all come with time. I like to think about real estate values by imagining them on a chart like you would see with the stock market that shows values. If you zoom in on that in the short term, you're going to see values go up and down, right? They fluctuate in the short term. There will be times in the market that we see it jot up like we did with COVID. There'll be times that we see values start to dip a little bit or level out. But if you zoom way back out again, you look at that 10, 15, 20-year trend or more, you will see that the general trend of real estate is always continuously up. This is why real estate works. This is why it's one of the safest investments that you can make and why it's an opportunity for you to build real wealth from your property. So we talked about waiting too long. We talked about not waiting on the perfect time because you really don't know what's going to happen next in the market. I'll tell you from COVID, for instance, everyone expected the market to drop, right? Everybody was out of work. All of a sudden, the entire economy is shut down. What we didn't expect is that the feds would cut rates to zero for the Fed funds rate. All of a sudden, mortgage rates are just in a rapid decline, and that just drove supply and demand issues way out of whack, right? We didn't have a lot of supply. There weren't a lot of people looking to sell in the early days of COVID. There were a lot of people that all of a sudden became qualified for much higher values than they had seen pre-COVID, and using that buying power, now all of a sudden there were many, many buyers coming out of the woodwork. Add to that mix that you have people from New York, from Boston, from other areas of the country that simply couldn't leave those places for employment. And then all of a sudden everybody gets to work from home. Now you start looking in other places and you find a state like Rhode Island where we have some nice coastway areas, right? And in those places, what we see as those properties being fairly expensive to someone that was living in Manhattan, what they would leave as a down payment on an apartment that they wanted to buy in the city could probably buy them a house in Narragansett for cash or close to it. So why wouldn't they move if they no longer have to go into the office or only have to go in once a month, right? So we saw this huge influx of people from out of state moving in. We saw this rapid decline in mortgage rates that brings affordability up. And in the early days, the values weren't getting out of hand right away, right? So we saw this this mass amount of buyers back into the market, very low inventory, but very low rates. So all of a sudden you see tons of people at every open house, tons of offers. I mean, I had a listing in Warwick one time that the police had to come because the street was just so packed with cars. I had over 150 people at a 2-hour open house. It was the one day of showings, and we ended up with 30 some odd offers and accepted a ridiculously high offer, way above the expectations of the seller. No inspections. We're willing to waive appraisal gaps. I mean, it was a crazy time to be involved in real estate, right? But the key there is you zoom way in and you're going to see this huge increase in real estate values. Now, if you continue watching, there will be a correction. There's no doubt about it. There will be a correction at some point in the market. You don't know when that's coming. I don't know when that's coming. We can start to feel the change as it's happening, but it's very difficult to predict. Nobody has a crystal ball, right? So we look at signs, we look at indicators, and we can make an educated guess. But at the end of the day, that's all it is an educated guess, right? The only guarantee you're going to have is if you can tell the future. And since no one's figured out how to do that yet, I would say that it's very difficult to try and time your search to what you would consider the perfect market. In the time that you're waiting, you're missing out on incredible opportunities. I'll give you another example. About a year or two into COVID, I had these clients from out of state that were looking down in Bristol, and we found this amazing property, multiple tiers of decks facing the water. It had over an acre of land with a private beach. They had mooring in the water there and the ability to add a dock. It was an amazing house. And at that point, we were under contract for $950,000. The clients did their inspection, and they chose to end up backing out of that deal. I'm not a hard sell kind of guy. So I gave them my opinion. And in this case, I'll tell you what they backed out because of. $950,000 house, multiple tiers of decks, private beach with the ability to build a private dock, and already had a mooring, right? It was everything that they had been looking for, the right size, the right location, the right price, everything. They ended up backing out because in the grand foyer area, in the entrance of the house, there were some extremely large windows, and it made the hardwood floors in that area wear differently than the rest of the house. To them, that was just unacceptable, right? They couldn't deal with it. And I tried to explain to them that, listen, we can get in here and refinish these floors for you. You'll never notice the difference. Will it happen again eventually? Probably. But what an amazing house. So they end up backing out. It ends up taking them over a year, probably closer to 18 months, to find something else that suited all of their needs. We ended up finding another place in Bristol, but by the time we went under contract there, the market had increased to the point where they were paying $150,000 more for this house that ended up not having nearly the features of the first one. Most importantly, they were really looking for private water access. Now they were 3 blocks from the water, and the only room in the house that had a decent water view was their master. There was nowhere else in the house you could even see water from. In an 18-month period, they went from on the water, private beach, all that house had to offer, to 3 blocks from the ocean, very few water views, and they ended up paying more for it. So this is why you cannot wait for that perfect market. When you find the house that you know is right, you have to be ready to act on it. This is what I see people getting wrong, and I don't want to see you make the same mistake too. So now we're going to get started on sort of a step-by-step guide on how you would approach buying your first property. The first piece starts with getting your finances in order. That includes credit, that includes income, and debt. Those are the 3 most important factors when you're going to apply for a mortgage pre-approval, right? Credit, it's not what everybody thinks it has to be, right? Everybody assumes, when I talk to people that are looking for their first homes and they don't have a lot of experience, they just assume that you're going to need a 700 or a 720 or higher score to get qualified for a mortgage. Know that that is absolutely incorrect. FHA standards are much lower than that. It's around 580 to qualify for an FHA mortgage. Now, obviously, your rates are going to be a little higher because that is a riskier loan for the bank, but it is always possible. You will put yourself in a better position the higher you can get your credit. Now, I bring that up because when you're looking at what's going to fix your credit, what's going to improve your score, it's not always what we think it's going to be. And this is why speaking to a lender early in the process is going to be super important. And that is actually my step 2, right? Step 1 is get your finances in order. Step 2 is talk to a lender early. Now, Those two steps can go hand in hand, right? Because sometimes you don't know what you have to do to get yourself in a better position until you speak with the lender. I had a client that was in the process of applying for a pre-approval. They were told that if we get the credit up a little bit more, that we're going to get a better rate. It's going to lessen the amount of PMI that they have to pay on the loan. So rather than working with the lender, asking questions about what should be the best things to pay off, they decided that they know that they had a collections account on their credit. And I think most people would probably assume, myself included, that the right thing to do would be to pay off a collections account, that can't be helping your score. And if you're looking to increase the score, why wouldn't you pay that off, right? Well, in this situation, by paying off that collections account, it actually hurt their score. Not something I saw coming, right? But the loan officer that I most often refer people to, his name is Nate Colwell. He's with Movement Mortgage. Absolutely top-notch loan officer. He has all different programs, is super responsive, answers questions completely. He's got a whole team built around him. I cannot recommend him highly enough. One of the most important things that he'll help with early on is coming up with a credit plan if you need that. Had my client that paid off that collections account come up with a credit plan with Nate, they could have avoided what happened next, which was a lower pre-approval at a higher rate. The reason behind it is this was a very old collections account. It had been reporting to their credit for a long time. There's a lot of different factors that go into determining that credit score. In this case, by paying that off, it wasn't a very large amount, but by paying it off, it now made that long-standing account on your credit show as a closed account. That actually hurt the score more than removing the collections. I wouldn't have seen that coming. The client certainly didn't see it coming. Nate would have and could have advised better had he been involved with that process. We're going to move on to step 3, which is connecting with the right agent. Picking the right agent isn't going to look the same for everyone. Depends on the type of property you're looking for, the location, what kind of guidance you may need. It's important to at least start looking at what number of transactions your agent has done. You can go on sites like Zillow. You can check an agent's reviews. You can see their recent transactions. Just make sure that the agent that you decide to work with has some experience, has some knowledge, right? You don't want somebody that's not familiar with the market, that's not in it every day representing you. I see so many times that we know someone that is licensed. That just because you're licensed doesn't mean you automatically know how to do the job. In fact, the class that we teach and the test that you take to obtain your license, it doesn't have a lot to do with what comes up in the real world. There's nowhere in the class that it tells you how to run comps or use MLS or how to be aware of market conditions, what to look for, what indicators are we seeing for value, for rates, for things like that. None of that is taught in the class. That comes with experience and knowing the right people. So that's why it's important to pick the right agent. All agents are not created equal. Now, because I'm in sales and I'm here, I have to give you a sales pitch. So I'm apologizing in advance, but I'm going to tell you why I think you should work with me. Number one is I always have the mindset that I want to win the client and not the deal. Some agents will do or say whatever it takes to get a deal. I will only work on your behalf, not for the transaction. I'm okay losing a transaction if I keep the client, because at some point you're going to transact again, right? And I want you to know that you can trust my opinion. I'm not afraid to tell you based on my construction experience that when I walk into a basement and I see something that's clearly not right, A, you've got to have the knowledge and the experience to recognize that it's wrong. And B, you have to be able to be willing to lose out on a house by telling someone that it's wrong. I take my fiduciary responsibility to a client very seriously, and I work for you. My mindset is always that I am going to be of service to my client. I have not forgotten that real estate is a service industry at the end of the day. We are here to serve you, our clients. I am here doing this podcast as a way to help initiate that process, get you thinking differently, get you thinking long-term, get you thinking about the equity and the wealth that comes from property ownership. That's step 1, right? But you have to have an agent that knows what they're doing, that's experienced, and then that knows how to negotiate and actually win a deal. Don't be afraid to talk to a couple, and don't sign any exclusive agreement until you're confident that that person is who you want to work with. In my business, I choose to only have someone sign a showing agreement, which essentially is covering me for that if I'm showing you a property, that you're working with me on that property. But I don't sign an exclusive agency agreement until much later in the process, because I don't think it's right to make you forced into working with me if you change your mind about me. I would always let clients out of an exclusive representation agreement if they ask. And I would continue to do that, because if you're not happy with the service that I'm providing, you should be free to shop around and talk to another agent. I will prove to you that I'm going to work hard for you every day until we put you in the house that you want and that you deserve. Now, my sales pitch is over, so back to business. The next step is to start searching. Now, you have to do that strategically. I don't recommend just going on Zillow and just randomly scrolling through all of the listings. There's a few ways you can do it, but start out not online. Start thinking about what is most important. Have a list of the must-haves and a list of the wants. Must-haves are things like how many bedrooms you have to have, how many bathrooms you have to have, if you need a minimum square footage, if you need certain cities or towns, or to avoid certain cities or towns. Those are important things to start out your search, just so you don't start looking at every house in the entire area. You start narrowing it down. Now, if you're not good with Zillow, with Realtor, with those type of websites at narrowing down the search, your agent can help you. I always set up my clients on an automated search from MLS, where you get all of the prior day's new listings that meet your criteria. On the MLS system, agents have access to a lot more criteria to search for than a lot of the websites. So we can really start honing it in, but we've got to know what your strategy is. We've got to know if you're looking for something that you want to add your own value to that needs work, or we need to know if you're looking for a totally move-in ready property that needs nothing. Now we're going to move on to step 5, which is making the offer. This is where that experience with the agent will really come in handy. So when you are looking at making an offer, we're going to see several different numbers out there, right? When you look on any listing, it'll show you the assessed value. We'll have to later worry about an appraised value. We'll see the listing price. We'll see your pre-approval amount. All of those things play a role in the process one way or another. Assessment is used for taxes. Appraisal is used to base your loan amount on. Pre-approval is obviously your max that you can go. The listing price is what the seller wants for the house, right? All of those things play a role, but none of them really show you what the true market value of the property is. The way that we look into value is based on comparable sales data. That's the most important indicator for value. We're looking at properties close by that are similar size, that are similar quality, and what did those properties sell for? Because ultimately that's what an appraiser is going to look at later, and the appraiser is going to help determine what the bank can offer as far as a final loan amount on a property. It's a percentage of the true value of the property. So why wouldn't we, when we're looking to make an offer, look at the same indicators that an appraiser would look for later in the process? That's how we're going to determine the true market value of the property. I'm a big believer in basing your offer based on the true market value rather than the listing price. We're going to see the listing price in some cases be substantially higher than the true market value, and we're going to see some cases where it's substantially less than the true market value. Just by hearing that a property was purchased for over the listing price does not necessarily mean it's a bad deal. Lots of agents use that as a strategy to drum up interest. We've intentionally put a low listing price on it with the intention of garnering a lot of interest in the property. But when we're making that offer, the list price is not the most important thing. The true market value is. This is where your agent's experience will come in handy, because they're going to pull comparable sales data. They're going to have the knowledge and the experience to guide you on what is most important when determining the value. And then we base that offer off of that value. When it comes to making this offer, value is one piece of it, but it's not the only piece. There are other terms, especially if you're looking at things like multifamilies, that could make huge impacts on how acceptable your offer is seen. So we have things like the timing it will take to close, the strength of your financing, whether or not you want to conduct inspections or all inspections or waive a piece of them. For instance, if you're buying a house that has a private well or a septic system, you can choose to waive the home inspection but not the septic inspection, and so on. Another thing that can hurt or help your offer is something like an appraisal gap. An appraisal gap is when a property is under contract for one price and the appraised value from an appraiser comes in below that price. For instance, if you made an offer that was accepted at $700,000 and the appraisal comes back at $650,000, now that extra $50,000 has to be negotiated at some point, right? Either you as the buyer will need the seller to come down to match the appraised value, or you can offer some amount, it doesn't have to be the whole $50,000, above that appraised value to strengthen your offer, make the seller feel more confident that your offer is A, going to close, and B, get them the best deal. So in a case like that, where it was a $50,000 difference, I'd hate to see anyone pay a $50,000 appraisal gap unless it was absolutely their dream home, everything lined up, and it was the I gotta have it house. You can really help your offer and the chances of it getting accepted by saying, I'll pay $10,000 above the appraised value. Now, in practice, you hope that you never have to pay that extra $10,000, right? You hope that the appraisal works out. But in the situation I described, if it appraised at $650, now you're going to buy it at $660. That $10,000 has to come in cash. It can't be part of the loan. So if you have the additional ability to make that extra payment at closing, it can really help strengthen your offer. So those are just some of the pieces, and we'll get more in depth in this stuff probably on a whole separate episode just about things to consider when making an offer. But to keep things moving, we've gotten to the point where we're making an offer, and the next piece is the inspection contingency. This will be, of course, part of the offer and plays hand in hand. But what does it mean when you have a home inspection? Many new buyers that I talk to think it's a pass-fail. It's not. What happens is you're paying for a home inspector that's licensed and insured to come out and inspect all aspects of the property. They're going to look at things like, are outlets grounded and are they all working? Are there any leaks? Are there any obvious signs of structural damage or things like wood destroying insects? How is the approximate age of the roof? What are we looking at for major systems like boiler or furnace, central air, things like that? What are the age and the condition of those systems? Every property there will be at least a 30 to 40 page inspection report on. I've seen new construction houses with reports just as long. Know that this is not a pass-fail. If you hire the right inspector, they will tell you which things to be super concerned about. They'll usually highlight them for you in the report, and they'll tell you about them when you're in person, that these are significant issues that you should really be concerned about. Then there are a lot of other issues that come up that are more maintenance issues. We see a lot of times where you just need to sort of get something serviced, or you just need to keep an eye on it, make sure nothing changes with the situation. That will all be in the report as well. But it's good to know the difference between which things have to get done right away. So now we figure out if we're going to ask the seller for a credit or a repair, or if it's more of a maintenance issue that the buyer is just going to have to take on over time. Again, the experience of the agent here will be very important in picking the right inspector. Most buyers' agents will have inspectors that they like to work with and that they will refer you to. Just know that you don't have to use their people for any of it, right? I've found industry experts that I trust with the business of my clients. And so I'm happy to make those referrals, but know that you don't have to use any of them. That being said, I have a home inspector that I always refer because unlike a lot of the home inspectors that take the class, pass the exam, and now they're a home inspector, yes, there are more requirements than that, of course. Right? It's not that simple. They have to do a certain number of hours or inspections under a more senior inspector before they're able to go out on their own. But I would prefer to work with someone that has been there and done that. You're going to see that as a theme throughout my podcast. It's important to take advice from those who know better because they've been there. The reason I mention that is my inspector that I refer people to, his name is Chris Semper. He's the owner of a company called CSI Inspections. And he spent many years in the construction industry. So not only did he take the class, pass the exam, do however many hours he needed to do, but he's got 20 years of experience working on houses, knowing what to look for. There's a lot of people out there that are inspectors that I would consider jack of all trades and master of none, right? And they can know just enough to be dangerous about a lot of things. Know that an inspector should also not be bringing up estimates with you. They shouldn't be talking about prices of repairs, but I've seen it. I had an inspector on a listing of mine that I wasn't representing the buyer, so they were there with their inspector. Their inspector noticed that on the exterior of the house, there was fraying to the main electrical wire that feeds into the electric meter. Not being in the business, you're going to think that this is a rare thing. It's not. We see that on probably 60 or 70% of all inspection reports because it's generally on a side of a house somewhere that nobody ever goes over and really just looks at. And so it happens over time. This issue comes up quite a bit. And in this case, the buyer asked the inspector, approximately how much do you think that would be to repair? But an inspector is not the person to give you that price. The correct answer from the inspector in that scenario should have been, I can recommend that you call a contractor and the contractor could give you a quote. In this case, the inspector told him that it was going to be at least $10,000 to repair that. It's so far incorrect and just shows that the quality of inspectors are not the same across the board. Because I am a contractor, I offered to have that person a quote by the end of the day and followed up with that. Using my construction company, we were able to quote him out at $3,500. So about a third of what the inspector said was the minimum price on that. So know that choosing an inspector can be important, but it is not a pass fail. Now, once you get that inspection report, you work with your agent or with the inspector as well to come up with which things are the most important, right? There's always going to be things found during an inspection. Then you work with your agent to figure out what we do with that information. So you have a few different options at that point. You can just say, I'm unhappy with the results of the inspection. I am no longer interested in this house. And at that point, you can choose to back out of the deal. If you back out of the deal within the agreed upon time frame for the inspection, generally it's 10 business days from when a purchase and sale contract is signed by all parties, in Rhode Island anyway. In every state, they have different ways of doing it. In Massachusetts, it's much less than that, and it's negotiable. In Rhode Island, it's a standard 10 business day in every P&S unless you agree to other terms and indicate that within the contract. So within that 10-day period, you've done the inspection, you've gotten the report, you say, I'm not happy with it, I can back out. When you back out, you will get any deposit money that you had left in the early stages of the contract. You can retain that deposit money. It'll come back to you. The other option, if you're not happy with all of the results of the inspection, are just to negotiate how we move forward. Again, working with your agent and your inspector, we come up with a list of things that would be required by you to present the seller with required repairs, or in lieu of repairs, they could also offer you a credit or a price reduction equal to the amount of those repairs. Now, that all has to be negotiated. It's not going to be the same on every deal. Some sellers will work with you, some sellers will not. So let's say you do the inspection, you don't want to back out, but you do want some things repaired. So you can ask the seller by way of a post-inspection agreement, by working with your agent, for the seller to either repair or replace certain items, or to offer a credit or a price reduction to account for those repairs to be done by you after closing. If you have the ability to handle them after closing, I generally recommend to do that and receive the credit. The credit is less that you would have to bring to closing. So it does put more cash in your pocket, which will allow you to pay for those repairs. The reason why I generally advise that is when a seller is doing it and they know they're selling the property and they just want to be done, of course they're going to look for the cheapest way to do it, wouldn't you? So if you're the buyer and you're going to be the one that's just buying the house, you may want to do it differently than the seller would do it, or use higher quality materials than the seller would. So know that those are things you should discuss with your agent, but come up with a strategy. Either we just want to back out, B, we just want to move forward, or C, that we want to negotiate some type of either credit or repair to account for anything that's needed in the house. Know that you're never going to get everything that's in the inspection report. What I like to do is come up with an aggregate. What are the most important things? What are the things that I feel like I have to have done in order to be comfortable moving into this house? And we come up with a dollar amount for that, or we ask the seller to repair, and you come to a reasonable agreement in the middle. Sometimes we make our best efforts to come to a reasonable agreement, and either the buyer or the seller just can't agree to those terms, and we have to move on. Again, if you back out within that agreed upon inspection time frame, you'll get your deposit back, and we move on to the next one. Now, after the inspection, the last real hurdle that we have to get through is the appraisal. We should already have a pretty good understanding of what we expect the property to appraise for, but now you actually have to get that appraiser from the bank, or that the bank hires, to come out to the property, and they do a full inspection on it, right? If it's an FHA or a VA loan, they will also be looking for things like conditions of certain items. Those loans have requirements that conventional loans don't. So the appraiser will come out there and do that FHA or VA inspection along with determining the value. They'll need to go in and inspect every room. They'll need to take pictures of every room. And then the bulk of their job is pulling that comparable sales data and making any adjustments for houses that are close but not exactly like yours, right? There's not going to be too many houses that are a one-for-one exact match. Could be a slightly different bedroom count or square footage amount or an extra bathroom. The appraiser will know how much to adjust a value up or down based on what the subject property, the one that you have under contract, has in it compared to the ones that it's comparing it to, the other comparable sales data. Now, once the appraiser determines the value, you're going to find out not only what they determine the value to be, but what data they used all along the way. You'll get a full appraisal report. It goes through a list of comparable sales that the appraiser compared the subject property to, and will show all the adjustments that were made along the way. In the end, it's going to have two check boxes that show that the value is either as is, meaning that there's no repairs needed to the house and it's worth that amount today, or there's another box that they could check off called subject to. We see this most common in FHA or VA loan, where there's something like peeling paint, and they say that the value is $650,000 subject to the repainting of a certain area that had that peeling paint. That's just one example. It could be a variety of different factors that go into that. But you'll see that full report. With that report, if there's an issue with the value and it comes in lower than what we're under contract for, this is where that appraisal gap I mentioned earlier would come in handy. This is where you would see the report at 650, and now you know you have to pay that additional 10,000 to make the final purchase price 660. Now, there are also times that we don't bridge the gap. In those cases where you are under contract for 700 and it appraises at 650, either the seller is going to agree to take the appraised value, which is the 650, because if it's appraising that low, then they're going to have issues getting 700,000 out of anyone, right? So in many cases, they will come down to the appraised value, or you could offer to pay the entire 50,000 because you want the house that bad, or we meet somewhere in the middle and say we'll agree to X amount over the appraised value, and the seller agrees to take less than 700,000 but above the appraised value of 650. What I see most often happen here is that many buyers do not have the ability to offer an appraisal gap in addition to paying for their down payment and closing costs. So usually we see the seller either come down to the appraised value, or we just all agree that unfortunately this deal isn't going to work. It no longer makes sense. And so the deal isn't going to work. And at that point, as long as you're within the time frame of your financing contingency, you back out. And again, you retain your deposit. Now, once we make it past that appraisal, the last thing to do is get ready to close. So on those last final days where you're maybe processing the last few items from your loan that's required by your lender, then we're also going to do a final walkthrough, usually the day of closing or the day before. The intention of a final walkthrough is to make sure that the condition it is as the day you were taking ownership is the same that you expected it to be. The most common type of issues we see come up during a final walkthrough is if the seller left some items behind that the buyer wasn't prepared to accept, or they left some kind of mess behind during their move, or they put some kind of hole in the wall while moving furniture around. Those are all things that we can get through by way of either a last minute credit, or we agree to handle it outside of closing, or the buyer just says, hey, I was going to repaint that wall anyway. It's no big deal to patch a little hole. I don't want to delay anything about it. We just go ahead with the closing. But the point of it is to make sure that you have all the information. Once you are the owner, you are now responsible unless there was some material defect that wasn't disclosed. You're going to be responsible for making any repairs there. So you want to get your eyes on the condition of the property as of the day that you own it. Now, once we leave that final walkthrough, we head down to the attorney's office, you sign a whole bunch of paperwork, and you get the keys. Now, all that hard work pays. Stay tuned for future episodes where we'll be breaking down how you really build equity, including how you add value to properties yourself, which most buyers completely overlook. You got value from this episode and you're considering buying a home, whether it's the next few months or by the end of the year, don't try to figure it all out on your own. A quick conversation can really help save you a lot of time, money, and stress. I'll make sure I leave my contact information in the comments. Feel free to give me a call, even if you just have any questions. I'm happy to help walk you through it, point you in the right direction if it's not something I can help with myself. And if you found this helpful, make sure you subscribe and share it with someone who needs to hear it. I'm Dave Zuller, and this is Foundation to Equity, building wealth one property at a time. We'll see you on the next one.